Hello again, welcome back to the second part of this video. I hope you enjoyed the first one. I have removed the EA from the chart and I'm going to reattach it so we can get on to the parameters definitions. So you want to click allow algo trading like I said in the last video. Then after doing that, come on to the input tab, and that is where you see all the settings, and some of them are self-explanatory, while some I have to explain to you to better understand how this EA works. So asset class, it means if you want to trade VIS, which is synthetic indices, or cryptos, stocks, or stock indices like US30, Nasdaq, S&P, etc. Then you have to make sure this is selected. But if you want to trade currencies, forex, you have to select FS. Sorry. And if you want to trade metals, commodities, and gold, oil, then you have to select gold and metals. That is very, very essential. This is essential because the calculation for each lot size in all of them are different. Here is trade direction. That is self-explanatory. If you want to long only, short only, or both, you want to hedge long and short at the same time. This is also very, very important. It is a unique number. It's mostly called magic number, but they are unique identifiers used to identify each EA when attached on several charts. Like you have it attached on step index, you have it attached on volatility 201 Hz, you have it attached on gold. You want to make sure that the expert number, the magic number for the one on step index is different, maybe 1 to 1. And why the one on 201S, you can use maybe 201S. And the one for gold, you can use maybe 5551 or something like that. But they have to be different to avoid interference between them. That is just it. It doesn't do anything with the strategy. It's just to make sure there is no interference between EAs when they are placed on multiple charts. Risk mode is self-explanatory. Do you want to risk a fixed amount on every trade? You can change it as you please. Or do you want to risk a percentage of your account balance? If you want to risk a percentage of your account balance, then you can change this to percentage risk. If you want a fixed amount, then you can put it on fixed risk. And here is a fixed risk amount where you can define the amount you want to risk, and that is in USD. So here now I've placed this as $20 per trade. Until I change this, no matter your account balance, it will always risk $20 per trade, except in some special occasions, which I'm going to talk about shortly. And if you have percentage risk selected here, that is where this comes in. That is account percentage risk. So here is percentage of your account balance that you want to risk. You can risk 0.1% of your account balance. You can risk 0.5%. You can also risk 10%. It depends on you. But if you have fixed risk here, then this is not used. And this will make sure every trade it risk this amount of percentage on the particular balance at that particular moment. Here, trade below minimum lot size with minimum lot size. In volatility indices, or let me say synthetic indices, they have minimum lot size, which in some assets, the amount you may choose to risk may not be able to open a position size which is above the allowed minimum lot size. Let's assume you want to redeem maybe $1. On volatility 100 index, the minimum lot size is 0.2. If you are trying to risk maybe $5 or $10, and then you get a position size after calculation of 0.1 lot. 0.2 lot is the minimum lot size, which means 0.1 lot cannot open a position. So what this does is, in the case your calculated lot size is below the minimum allowed lot size, it should use that minimum allowed lot size as the lot size for that position. if this is false, then it will not take that trade when your loss size from calculation is below the minimum loss size. But if you leave it on true, it will use the minimum allowed loss size instead. But when your risks are above the minimum loss size, then it will use that loss size. This is take profit in RR. If you want to target 3R, you have 3R. If you want to target 30R, you put 30R. No limitations onto that. SL multiplier. This is where you place your stop loss. Let me quickly show you. It means if you have a bullish move, like in a bullish market like this, and price pulls back, that is a validation, let's just say like that. So that is where stop loss should go normally, but here we are waiting for momentum shift. So when price pulls back, and then we have a momentum shift, a shift in momentum, and then we take our entry on this point. Instead of stop loss going right here, stop loss go below this most recent created low, or let me say an anticipated bottom. The lowest low on this move down is regarded as 1. Your entry is 0. So this move between here, the entry, and the lowest low here is 0 to 1, which is 1. So if you have 1.2 here, it means this 1 plus 0.2. That is where the stop loss will go. If you have 2, like 2, if you have 2 here, it means this is 1 with another 1. So if you have this, if this is 1%, and then you get another 1%, and that is 1. So this becomes 2. 1 here, the distance is 1. The distance is 1 to 2. So your stop loss goes below there. So that is how this is calculated. You can use 1, which makes your stop loss go below that very low. And as you can see right here, assuming we are shorting this trade, this high of this green candle is the 1. So if you choose 1, then your stop loss will go right on this very high. But if you choose 1.2, then it will go a bit above. If you choose 2, then it will go the distance. If you are entry at this point and here is 1, then this same distance from here to here, it will extend and your stop loss will be somewhere above there. So you can play with this, especially when optimizing. You can also use 3, but then sometimes, you know, the bigger your stop loss from your entry, the bigger your take profit becomes, and price may be very sluggish in reaching that. So you don't want something too close, you don't want something too wide. Re-entry on SL, it's re-entry. This means if you are in a trade, assuming you are in a short trade right now, okay, let me do this illustration. So assuming you have a bullish move like this, you have a pullback, you have a change in momentum, you enter the trade right here, you place stop loss right here. This is invalidation, right? Then instead of price coming up, it doesn't do that. After taking you in, it just comes to trigger your stop loss. But this whole setup is still valid because the bullish structure is still valid in as much as this has not created a low per zigzag. That is zigzag. If it has not created a low, that means this bullish setup is still valid. So what happens in this case is, if your stop loss gets triggered and this is untrue, if there is a shift in momentum again to the upside, is likely to take another trade. But if this is false, that means the moment your stop loss is hit, even if it does something like this, it's not going to take any trade. It's going to wait for another pullback and another signal to present itself. Enable trailing, we all know what that means. Then start trailing at R. It means what R do you want to trail? Stop loss. If you want to trade stop loss. If you don't want to trade stop loss, just leave that as false. But if you want to trade stop loss, then what R do you want to trade? Some people like to trade early, that the moment you're in a trade, if you start making profit to the tune of 1R and you want to move your stop loss to break even, then put 1R. So that means once you're in a trade and the trade goes in 1R in favor, then here trade price by R, then select 1R here. So the moment price reach 1R, your profit gets to 1R, it will trail stop loss by 1R from current price, which is, it will put your stop loss on break even. But if you choose this as 0.3, it means the moment price is at 1 hour, it's going to deduct that 0.3 from that 1 hour, which means it's going to place your stop loss as 0.7 hour. Let's assume now that you take a trade here. You have your entry, your stop loss is here. Difference between here to here is 1 hour. So let's assume this is 1 hour in profit. So the moment price reaches this place, that is 1 hour, then trailing will kick in. If you have 0.3 here, then it will be 1 hour minus 0.3, which is 0.7 hour. Then 0.7 hour from entry will be somewhere around there. It will put your stop loss there. But if you have this at 1 hour, which means 1 hour minus 1 hour from entry will give you break even. Then it will move your stop loss to break even. If you have this at 0.5, then it will place your stop loss at mid range, that is 0.5 hour. And the moment price keeps rising, your trailing stop loss will keep following with this distance. So that is that. Confirmation, entry confirmation time frame. This is the final time frame which we are going to look for to perfect our entry. So if you are trading, okay, let me just say this now. This time frame, as we can see here, we have 4 different time frames, which is 1, 2, 3, 4. It doesn't mean all these 4 time frames are used. It depends on the module which is selected here. We can use a total of 4 time frames together, and we can use a minimum of 2 time frames together. And what this means is, this is an anti-frame bias. You can set this to 4 hours, to 1 day, to 1 hour, depending on your trading style. That is just for directional bias. Why this first signal time frame is where the first signal for trading comes. When this shows that price is within the point or the zone of interest, then it starts watching for signal criteria. Once that is met, then it goes on this entry signal where it finds your entry confirmation, the first one. So the moment an entry signal is spotted, it then goes on this confirmation time frame, which is the final one to execute based on another entry signal, which means if you are using 1 hour as bias, 15 minutes, if a signal is spotted, let's assume, let me do this. So let's assume we are in a bullish trend. We are interested in longs, right? High time frame, 1 hour is bullish, 15 minutes is bullish. So let's assume we want to use Fibonacci for our signal here. So we say if Fibonacci, if price pulls back by 61.8% Fibonacci, that means the moment price corrects into the golden ratio, this we see that signal condition is met, and the moment this signal condition is met, it tells another algo in the bot that my condition is met. Now start looking for an entry signal. Now let's say our entry signal is a bullish engulfing candle. So the moment price is below this golden ratio, then an engulfing candle shows itself, which confirms a likely bottom at this point. That means entry signal is found. Instead of just going long at that particular time, we go down to this 3 minutes. And what are we going to do there? We are going to find another entry confirmation to confirm that yes, we are truly going up. Sometimes can be a break of structure on the 3 minutes, then pull back and retest. Sometimes it can also be the same pattern as this signal, entry signal, which means if this has given us an engulfing, which means 5 minutes in this case is forming a bottom, then we want to go to whatever time frame we set here to make sure it's also forming a bottom, either a change of momentum, break of structure, or whatever it is. What time frame you use now will be dependent on whatever module you select here. So as we see in entry signal time frame only, what it means is use only this time frame here for bias, for structure, for everything, and that is mainly for scalping. Now as you can see here, it says align entry time frame, and this is entry time frame. So if you want to align this particular entry time frame with this time frame, this will be true. But in some cases, some people trade in a way that once their bias is bullish, they don't care if that low time frame is bearish. They believe it's going to flip bullish. So to catch a very good risk reward, they just take an entry the moment they see an entry signal. So that is why this is not included in this, to also make things easier for the programming. So here, if you choose entry signal only, it means you will use this entry signal for your bias, for your entry signal, for your signal, for everything alongside with this. Now, if this is true, then it will pair both of them and make sure when this is bullish, this is bullish. If it's false, then when this is bullish, whatever this is doing doesn't matter. And if here you have first signal time frame only, then it's going to use this time frame bias, for signal, for everything. When this is bullish and it sees a signal, it will still go down here to ask it to find an entry signal, but it won't regard this market structure on this time frame. Neither will it regard the market structure on this time frame. But if this is also true, then it will make sure that whatever that lowest time frame is doing is in confluence with whatever 15 minutes is doing. Here, if you have align first signal time frame with entry signal time frame, it means this time frame and this time frame, if you want to take long, both of them has to be bullish. And if you have this on true, then this must be bullish as well. But if this is false, then this won't matter. So it must be bullish, 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 or bullish, bullish, false. And here we have align high time frame with first signal, which means you are using this high time frame bias wherever you put. So when this is bullish and you want to go long, then this has to be bullish. Whatever this and this are doing won't matter, except you have this here, which will then reflect on the last confirmation, entry confirmation. And if you have align all time frame except this, so it means you are using this time frame for bias, using this time frame for signal, and using this time frame for entry signal. So if you want to go long, this must be bullish, this must be bullish, this must be bullish. And if you have this on true, this also must be bullish. So if this is for 1 day, this is 4 hours, this is 1 hour, and this is 15 minutes, all of them must be bullish for you to see a trade. So that is that with that. Then here you have activate both on fib levels. I've explained that if you want to use Fibonacci range, if you don't want to use it, we'll keep this on false. If you want to use it, you keep this on true. And whatever level you want to use, you can select it here. As you can see, I have a front runner here because sometimes you choose to use 50% range and it doesn't get there. 50% is not a Fibonacci level, but most times we see 50% as discount levels. So when price corrects up to 50%, that means bottom can be found anywhere else. Whereas in some cases, they get front run, price never gets into that level, gets to the 48 and then reverses. That's why I have these two levels here. But you can use the 61, which is golden ratio, the OTE, the ultimate level, that is 79. Then here, reset fib signal on either break of structure or when higher low forms. This is interesting in the sense that if you have a bullish move like this and you are waiting at the golden ratio, price pulls back into the golden ratio. The moment a bottom is formed there and price goes like this move from this point to this point on these 3 minutes will be something like this. It will be in waves, right? If you want to keep entering trade at each pullback like this, it is possible. But then if that is done, the moment an higher high like this is created, price can return and start pulling back any moment from there, to not allow you to be taking trades when there is a massive pullback like this, thinking it is just a minor pullback on the lowest time frame, for you not to start taking wrong trades. That is why this is here. So are you going to disable the bot from taking any more trades the moment this high is broken, or the moment a re-high or a re-top is formed? That is what that is. Let me end this video so it doesn't get too long, and in the next one I will continue with the rest of the parameters before we then proceed to back testing visually and then optimizing to get the best parameters. So thank you for watching.